Hello and welcome, Principles of Accounting 1. I'm your host, Dr. B. It has been a wonderful time working with all of you over the past 6 weeks. We are reaching the end of our course. We are now in week 7. This week we cover the last 2 chapters of Principles of Accounting 1, Statement of Cash Flows and Financial Statement Analysis. What does that mean for you? You might be asking. Well, hopefully, you are in a passing position. What do I mean by that? You should have completed all of your coursework except for chapters 13 and 14 by now. You are required to have all of your coursework, including chapters 13 and 14, submitted by this Sunday night. That is it. That is pretty much the last day of quote unquote class, right? The reason why all of your coursework is due by this Sunday night, and I'm talking about anything that could be possibly passed to or whatever, go ahead and take care of it. If you need to retake some quizzes or homework assignments, please, this is your chance. You need to have it done by Sunday night. The reason why everything needs to be done by Sunday night is simply because we have reached the end of our course. Since we reached the end of our course, everything is due by this Sunday night. And I'm talking about chapters 13 and 14. I'm talking about anything that's past due. If you want to retake a quiz or homework assignment, that must be done by this Sunday night. The reason being is because we are at the end of our course. Week 8, which is next week, is only 5 days long. Okay, this course officially ends on Friday, March the 5th. What does that mean? The final exam must also be completed by Friday, March the 5th. Friday, March the 5th. That is the last technical day of the course, right? There's only an 8-week course. Friday, March the 5th is the last day. So this coming Sunday night, which is February the 28th, last day of February, you need to have all of your work submitted. Anything, all past due work, all resubmissions, all whatevers, everything, the whole thing. Everything needs to be submitted by this Sunday night. No exceptions. Okay, so what does that mean? If you're missing anything past Sunday, you will receive a 0 for that, right? And you won't be able to get points, right? Well, I don't want that to happen to you. So please, if you're currently failing or if you're currently in a position where you're missing assignments, that must be submitted by this Sunday night. 0 exceptions made to that rule. Reason being, we're at the end of our course. Final exam is next week. Okay? I cannot be more clear than that. Are there any questions in regard to that? You all heard it, right? You all heard it. David, did you hear it? You heard it? Did you hear it? Did you all hear this?
Yes, we did.
Okay. Good. Thank you. Thank you. Thank you. At least some of you are awake. Okay. Yes. So please, I cannot stress it enough. If you have anything that's past due, anything that you want to have resubmitted for a higher grade, must be done by this Sunday night. 0 exceptions past that Sunday night rule. It's not me making that up. That's the university saying that. Okay. Reason being, because again, next week, final exam. Next week, final exam for this course. For your other courses, you probably have midterm exam next week, right? Because technically next week is the midterm exam week for UDC. After that, then you have your spring break after your final exam and midterm exams. And then after the spring break, for those of you who will be continuing on with me into Principles of Accounting 2, which you need a C or a higher in this course in order to continue forward, for those of you who continue on, that course will start on March the 8th. You will have access to that course starting on March 1st. I'm sorry, not March 8th. March, was it 15th or something like that? 16th? Something like that. I forget. You'll have access on the 8th. That course officially starts on the 15th. That's Principles of Accounting 2, for those of you who are coming along. For those of you who are not coming along on the 15th, you will probably see me again in the fall semester or in the summer, possibly, if they decide to run Principles 2 in the summer. Again, none of that is up to me. That's up to the administration. So, hopefully, right? You need a C or higher in the course to pass. So, again, if you scored low on a homework or a quiz, retake it. Yeah, try to get that 5 points. The final exam is worth 20% of your grade. Is that right? Let me just double check. I think it's 20%.
Exactly, 20%.
It's 10%. Oh, no, it's 20%. 20%. So the final exam is 20% of your total grade. Oh my goodness, 20%.
Is it due on Sunday as well?
I'm sorry?
Is it due on Sunday too?
No, it's due on March 5th, which is a Friday.
Oh yeah, next week.
Yep, next week. So the final exam is worth 20% of your total grade. It is due on March the 5th. That is a Friday. That is next Friday. Not this coming, but the following Friday. Okay? So it is open and available right now for you to be able to start it and take it. It's one attempt, so take your time with it, but don't take too long with it. You see what I'm saying? It's open book, open note, open everything. Yeah, take it for sure. Take your time with it. It's true, false, multiple choice, and magic. Very similar to your previous to your midterm exam.
One question.
Yeah, Richard.
So can we take it like in advance, or does it have to be specifically on March 5th?
No, you can take it right now if you wanted to. It's totally up to
great.
you. Absolutely. It's open and available for you to
Just one attempt?
It's one attempt. So once you click submit, that's it. So don't click submit, click save.
Okay, no timer.
No timer. I don't believe in timers.
That's just stressful.
Yes, it gives me anxiety too. That's why I don't do timers. Absolutely. Okay, great. So reminder, everything due this Sunday night, including previous work. After Sunday, it gets cut off, right? Then it's only final exam next week. You have until Friday to complete the final. I'll be continuously giving you guys a hard time because I'm gonna keep reminding you. Yes, I want to make sure that you're successful. That's why I keep pushing you like this. This is a very work-intensive course, as you already know. So just be mindful, pace yourself, try to spend as much time as you possibly can on this course this week. Okay. And that's where we're at. So everything's due by this Sunday night. No exceptions. All past work due this Sunday night. No exceptions. Everything is due this Sunday night without exceptions. Because final exam is next Friday. Clear? Okay. Sorry I got on my soapbox, but it's super important that you all are on the same page. Okay, let's get into statement of cash flows, and then we'll take care of financial statement analysis. These are the last 2 chapters of the course. This is our last WebEx session together. Until, of course, we meet again, which will be in Accounting 202. Okay, here we go. Statement of cash flows. The statement of cash flows is the, I guess, third, fourth financial statement that a business uses in order to understand its financial performance. The statement of cash flows represents all of the cash coming into and out of the business. We call this cash inflow and outflow. Think of like water, like a water pipe. You have water coming in and water going out. Cash coming in, inflow. Cash going out, outflow. Cash is generated from the day-to-day operations of the business. You sell products or services to your customers. They pay you with cash, right? Ideally. Cash does not include accounts receivable or accounts payable, because accounts receivable and accounts payable, they're not cash. They're similar to cash, but it's not actual cash. That's when a customer buys something on account, or you received a bill, haven't paid it yet. It doesn't become cash until you receive the cash from the customer, or you're actually paying the cash for the bill. See what I'm saying? So this statement of cash flows follows the physical cash flow. We maintain the statement of cash flows maintains and helps the business to maintain and expand operational capacity, meet financial obligations, in other words, pay its bills, and to pay dividends. These are the reasons why we look at the statement of cash flows as a tool in the business. It's used by managers to evaluate past performance and into planning in the future for investments and financing activities. We can't expand the business without cash. That makes sense. We can't finance the business without cash. That also makes sense. It is also used by external parties to evaluate the financial performance of the business. Okay, there are three primary activities identified on the statement of cash flows. The first is cash flows from operating activities. So there's three categories, a way to think about it. When you look at a statement of cash flows, it's broken out into three categories. The first one is the operating activities. This is the cash coming in and out of the business from the day-to-day operations of the business. An example would be we purchased inventory. Another example which means we're paying out. Another example would be we sold inventory to a customer. That's cash coming in from the customer. Day-to-day operations of the business. The second area or category on the statement of cash flows is called investing activities. Investing. And investing activities is the purchase or sale of property, plant, and equipment. The purchase or sale of property, plant, and equipment. These are investing activities. Think of it this way. We invest cash into our business to expand the business. Okay? How do we do that? We purchase property, plant, and equipment. Or we can sell property, plant, and equipment for whatever reason. Right? Investing activities. That's when you hear the word investing activities, automatically think property, plant, and equipment. That's the way to think about it. Okay? The third category on the statement of cash flows is called the financing activities. Financing activities. The name is exactly what it sounds. The company is financing their operations. The way that companies raise cash is by issuing stocks or bonds, or they take out a loan from a bank. That's what we call equity and debt financing activities. Equity, we're talking about issuing stocks and bonds. Debt, we're talking about loans. So the business can take out a loan or issue stocks and bonds in order to raise cash from financing activities. The opposite is also true. The company can pay down its debt, pay its loans, or they can buy back stocks and bonds. That's financing activities. Think when you hear the word financing activities, think stocks, bonds, loans. Financing. It's either debt or equity or both. The statement of cash flows, the way it's organized is it goes top down, okay, top down. The top part is going to be your operating activities. The middle part is going to be your investing activities, and the bottom part will be your financing activities. And it's organized similar to this, okay? We have cash flows from operating activities, plus or minus cash flows from investing activities, plus or minus cash flows from investing activities equals your change in cash plus cash at the beginning of the period equals your end of period cash. Here's how it works. You see the word cash flows. Cash flows. When you see this word cash flows, it means net cash flows. Net cash flows. We get cash flows from taking cash inflow minus cash outflow equals net cash flow. Cash inflow minus cash outflow equals net cash flow. Okay. And we do that same exact thing for operating, investing, and financing activities. So net cash flow for operating activities, that's cash inflow from operating activities minus cash outflow for operating activities. The same thing for investing, same thing for financing. So you perform those operations first, and then you figure out the change in cash plus cash at the beginning of the period equals cash at the end of the period.
On that note,
Richard?
so on that note, Professor, so I don't know if you heard about it when Tesla bought like 1.5 billion in Bitcoin, and then they just like made another billion when the Bitcoin went up like almost to 60,000 grand.
That's right. That's financing activities.
Yeah.
Yeah, it's financing. Because it's not property, plant, and equipment, so it's not investing. It would be a financing activity.
So how do we choose where to invest? Like what stock to buy or what to sell?
We're not going to get into that, in this course. This is an accounting course, not a personal finance course. But I would say the best way to understand which investments are the best when it comes to stocks is do some research on those companies that you're interested in. Look at their financial performance by looking at their 10K reports, and listen to the quarterly calls and look at their quarterly earnings to understand if that's a company that you want to invest in. That's the best advice I can give you. Legally, I can't give you investing advice because I'm just your professor. I'm not licensed in that area.
Okay.
I agree with that. You know, as a business major, I think that fundamental analysis and, you know, researching about a company's performance, I mean, it's actually available on the, I think, Bureau of Labor Statistics or the SEC
SEC.
page.
Yep.
Yes, because many people allege that Bitcoin doesn't have intrinsic value and it can go negative, but they just in speculation, so I don't really know. But the people that invested in GameStop lost all their money because they were following a trend. So I think doing research is best.
Absolutely, 100% agree. Yeah, Richard, that's good advice from Richard. I would definitely recommend that you do as much research as you can on a company before you decide to invest in that company. Because sometimes the company philosophy won't align with your personal goals, or they won't align with your beliefs. And so, like for example, like I personally don't invest in companies that sell tobacco because I have a belief against the use of tobacco, right? So I mean that's for that reason I don't invest in those types of companies. But it's all about your beliefs, your preferences, and what you like, right? Like I invest in Starbucks because I drink a lot of coffee. I like Starbucks. I'm there pretty regularly as a customer. Therefore, I invested in the company, and they have a great track record. But definitely, like Richard said, do a bunch of research as much as you can before you invest. And you could go through like what's the one's website called now? Robinhood or Ameritrade or one of those other stockbrokers. Yeah, good conversations. Okay, so as I said earlier, cash coming into the business, that is called a cash inflow. Cash going out of the business, that is called a cash outflow. Very straightforward. Yeah? Sources of cash. Operating, that's a sale of products or services, cash coming in from our customers. Investing, we sold property, plant, equipment. Financing, we issued stocks or bonds. Cash outflows, we're paying our bills, paying our employees, purchasing inventory, taxes, all that good stuff. Investing outflow, we're purchasing property, plant, or equipment. For financing, we're paying out dividends, repurchasing stock, also known as treasury stock, and repaying long-term liabilities. This kind of gives you an idea of the physical cash flow. In operating activities, that's the day-to-day operations of the business. Cash coming in and out of the business for day-to-day operations. That's why we call it operating activities. There are two methods that you need to understand when it comes to the statement of cash flows and how it's reported. Two methods of how we report statement of cash flows for operating activities. One is called the direct method, and the other method is called the indirect method. Both methods result in the same amounts, but they're different in the way that they're reported. We'll talk about both. First, let's talk about the direct method, which in my opinion is the easier of the two methods. The direct method reports operating cash inflows and outflows like this. Cash received from customers, that's cash coming in, that's an inflow. Then we have a bunch of outflows. Payments for merchandise, payments for operating expenses, payments for interest, payments for income taxes. So cash coming in, that's a plus. Cash going out, that's a minus. So inflow minus all of your outflows equals net cash flow from operating activities. Make sense? It's the easiest method. Direct method. Outflows, as we just discussed, are very common for purchasing inventory, paying the operation expenses, interest, income taxes. Cash coming in is payments received from our customers. Advantage is it's direct. It's very simple to track it. It reports cash coming in from your customers and cash going out for your expenses. That's why we call it direct. Yeah. The disadvantages of this is it's not readily available. In other words, if you go to the SEC.gov and you look at a company's cash flows, you're not going to see that. It's not because they normally use the indirect method. Let's talk about the indirect method. And just if you look at this and you look at this, we see the big difference, right? Direct method, it represents each line item. Cash coming in from customers, minus, 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 minus all of your outflows. In the indirect method, it doesn't report those things. It only reports the net change. So the indirect method reports cash flows from operating activities beginning with net income that we take from the bottom of our income statement, and then we make adjustments to net income based off of the net cash flow from operating activities. What do we mean by that? We take net income and we reconcile it to the net cash flow from operating activities. This involves taking our cash payments from receipts, subtracting out the cash we did not yet receive, or for the income side, we take cash we received from our customers minus accounts receivable that we sold on account for that accounting period. Then we subtract out all of our expenses that we paid in cash to get to our net cash flow from operating activities. It's more complex. It's not as easy to reconcile, and it does not have as much information as the direct method does. But the reason why people use this method is because it's quicker to calculate. And those are the advantages and disadvantages. Okay, so looking at it from an example, we can see that the direct method and indirect method yield the same net cash flow. Again, the difference is how it's being reported. I personally prefer the direct method because it's right there. It's very easy. It's easily identifiable. We don't need to reconcile anything. But in the indirect method, we reconcile net income. We add in payables, subtract out payments for various expenses to get to the net cash flow. We see it's the same exact result. It's the difference, of course, is being of how it's being reported. Okay, so that's operating activities. Let's talk about investing activities. Investing activities, as you know, is the purchase or sale of property, plant, or equipment. Property, plant, and equipment, investing activities. This is cash inflow would be the sale of property, plant, and equipment. Cash outflow would be the purchase of property, plant, and equipment. Here's how it looks. Cash inflows, obviously a plus, minus any cash outflows equals the net cash flow for investing activities. It's very, very simple, very straightforward. And again, it only involves the purchase or sale of property, plant, and equipment. I guess also intangible assets, which rarely occur. Remember the word intangible assets? We talked about that, I think, like 3 chapters ago. And we said that intangible means you cannot physically touch it. This would be things like trademark, goodwill, patents, those types of things. That would also be included because it's technically a fixed asset. Cash outflows would normally include payments to purchase these things. So cash inflow, we're selling property, plant, and equipment or other assets. Cash outflow would be we're purchasing property, plant, and equipment or other fixed assets. Very straightforward. Same with the financing activities. It's very, very straightforward. It's so cash inflow would be we are issuing stocks, bonds, or we're taking out a loan. Cash outflow would be we're repaying a loan, or we're issuing dividends, or we are we're purchasing common stock back from our shareholders, also known as treasury stock. So inflows minus outflows equals net cash flow from financing activities. And we just talked about that. Okay, we talked about operating activities, investing activities, and financing activities. Now we need to talk about non-cash investing and financing activities. Do you remember when we talked about this thing where we converted a accounts receivable to a notes receivable? You remember that? It was a while ago, right? That is a non-cash activity because we're simply taking it from one receivable and converting it to another receivable. Non-cash. Another example of a non-cash activity, that would be an operating version. From investing, a non-cash activity would be Investing would be we are given a gift, a piece of land, in exchange for supplies. That's non-cash. There's no cash changing hands. If there's a gift or an exchange, or what do they call that? Not an exchange. What's the word that means you gave somebody an item and you got another item in return? What's the word for that? Not exchange. There's another word.
Exchange.
A what?
Is it exchange?
I'm sorry, Regina. Can you say that again?
You said exchange?
Exchange, yeah. There's another word though. What's the word I'm looking for? I'm trying to remember. It's okay. Yeah, it's a not maybe a barter, I guess would be the word. It's where you
A bargain?
a bargain,
Probably, yeah.
a barter,
Bargain. Bargain.
bargain. Yeah, it could be. Yeah. It's the idea is that you're giving somebody something and you're receiving something in return, but it's not cash. It's like a swap or exchange or something like that. You see what I'm saying, though? No cash. And then from a financing activity, it would be like converting common stock or issuing common stock to repay a long-term debt. Those are non-cash transactions, but they indirectly affect cash flow. So we report those on a separate note at the bottom of the statement of cash flow. Just something to consider. So here's what the statement of cash flows looks like. Again, operating, investing, financing activities. All of the items will typically be listed out. And then at the bottom of each area, you'll see net cash flow from that respective activity. Toward the very bottom, you'll see net change in cash, that increase or decrease in cash. And that is based off of adding up your operating, investing, financing net changes. You get to your net change in cash plus cash at the beginning of the accounting period equals cash at the end of the accounting period. And then at the very bottom is going to be a separate note, okay? Non-cash investing. Non-cash investing. It's a separate note. Now it'll have a related dollar amount with that exchange. Okay, so that is the statement of cash flows. As I'm going to get going with some of your favorite topics, we call these ratios. I know you guys love ratios, right? Oh my goodness, I hope you do, because we're going to talk about some ratios. And the next chapter, financial statement analysis, a lot of ratios, tons of ratios. Okay, you don't need to memorize this stuff. Don't memorize the ratios. I want you to understand the reason why we calculate these ratios and what they mean. What they mean, okay? Don't memorize the formula, but I want you to remember what they mean. So we're going to talk about a couple of different ratios right now, and we're going to talk about a whole bunch of them in the next chapter, financial statement analysis. Okay, the first ratio for the statement of cash flows is called the cash flow per share. Okay, the reason for this ratio is we need to understand the company's cash flow as it relates to the number of shares that have been issued, also known as number of shares outstanding. What this tells us is the company's ability to pay a dividend. Okay, company's ability to pay a dividend. We find the cash flow per share by taking the net cash flow from operating activities, it's the top part here, divided by the number of common shares outstanding. That, again, tells us the company's ability to pay dividend. In looking at the indirect method, reporting cash flows from operating activities uses a logic that the change in balances can be analyzed based off of the changes in other balance sheet accounts. So, what does this mean? The indirect method, remember, we need to reconcile using the net income. How do we do that? Well, we can analyze the balance sheet accounts to get to that point. Assets equals liabilities plus equity. You all know that that is the accounting equation. Assets plus equals liabilities plus equity can be converted to cash plus non-assets equals liabilities plus equity. All we're doing in that in that conversion is we are separating cash from non-cash assets. And then this, oh my goodness, this probably brings some of you back to math class, right? This is totally math class at this point. Then we can figure out how much cash the business has by converting the accounting equation from cash plus non-cash assets equals liabilities plus equity to cash equals liabilities plus equity minus non-cash assets. All we're doing is we're putting non-cash assets to the other side of the equation. The only way you can bring from one side of the equation to the other is to convert the sign. Yeah? I'm sure you all remember that from many years ago from the math class that you learned that in. Okay. So any change in cash account can be determined by analyzing the change in liability in stockholders' equity. To do that, we simply take the change in cash equals change in liabilities plus change in stockholders' equity minus the change in non-cash assets. Cash coming in minus cash coming out equals the change in cash, right? And you do that same process. Using the indirect method, there is no order in which the balance sheet accounts must be analyzed. However, because the net income is the component for the indirect method and represents any changes in retained earnings, the first account we normally analyze is retained earnings on the balance sheet. Okay. Let's look at the income statement. On the income statement, as you know, we have sales minus cost of goods sold equals gross profit, minus operating expenses equals operating income. Operating income minus your other revenue and expenses equals your income before income tax minus income tax equals net income. Why this is important, we need to find the net income. Remember, we're talking about the indirect method, net income. We found net income. Now let's look at the balance sheet. We're looking at the changes on the balance sheet. How do you find the changes? Take 2018 minus 2017. Or in our case, 2020 minus 2019. So forth and so on. Very easy to find the change. You just take the newest amount minus the older amount. In our example, we had a net income in 2018 of $108,000. Since net income is closed out to retained earnings, the net income also helps to explain the change in retained earnings during the year. Retained earnings account indicates that there's $80,000 in change as a result from the net income of $108,000 and the dividends of $28,000. We're not going to get too deep into it. It's good to know. It's not as important to know, right? Okay. Now we got to talk about this thing called adjustments. You all remember adjusting entries. Oh my goodness, that was a long time ago, Dr. B. I know. Adjusting entries was like, I don't know, week 2 or 3. Oh my goodness, making me think back. So adjusting entries were those things that we had to make to adjust at the end of the accounting period in order to reconcile our accounts. You remember that, right? So oftentimes we need to make adjustments to our net income. And we know that because we needed to take our net income, put it onto the retained earnings statement to the balance sheet. Because of these adjustments, we utilize the accrual method of accounting. Revenues and expenses recorded during the time that they're earned. And under the indirect method, we must determine the cash flow for operating activities. So these are the type of adjustments we would make. This is your operating activities. There are non-cash items here. Depreciation, amortization. Those are non-cash items. Disposal of assets. That could be a cash item. It typically is. Get to your change in current operating assets. Increase in non-operating cash. Decrease in non-operating liabilities. We see that there are these types of adjustments that we need to make. The way to think about it is the statement of cash flows represents the physical flow of cash. At the end of the accounting period, there are non-cash items that need to be adjusted. This is, of course, in the indirect method. This is why it's more complex. So this slide kind of summarizes those types of adjustments. Net income is normally adjusted to the statement of cash flows in the indirect method. And how do we do that? We do that through these 2 steps. Step 1, expenses that do not affect cash are added. Step 2, losses on disposal of assets are added. Now their assets are deducted. Step 3, changes in current operating assets and liabilities are added or deducted through the increase in non-cash current, decrease in non-cash current, increase in current operating liabilities, decrease in current operating liabilities. Again, think of it through the lens of at the end of the accounting period, we need to make adjusting entries in order to reconcile our statement of cash flows. And this is how we reconcile our statement of cash flows. But good news is we're not going to get too deep into it. It's just more good to know stuff, right? Net income always starts at the top. Then we make our adjustments, depreciation, gain on sale of land, changes in current operating assets equals net cash flow from operating activities. It's just a lot of plus, minus, right? These are all the adjustments we make. Okay. Let's talk about, from our example, looking at net income of $108,000 converted to cash flows and operating activities of $100,500. There's a couple of adjusting entries that this company made. First one was to depreciation. Depreciation, as you know, is a non-cash activity, but it's still one that needs to be made. at the end of the accounting period. Step 2, we deduct gain of sale, another adjusting entry, deduct the gain of sale of a piece of land. That we gained on. So as you know, like things like land, they appreciate in value. So oftentimes when you sell a piece of land, it appreciates in value, and you typically get a gain on this when you sell that land, which is the appreciation value. In this example is 12,000. So we got additional 12,000 cash coming in from the sale of that land, and we need to recognize that in the adjusting entry process. Step 3, we identify the changes from year to year. Changes in accounts receivable. So as customers pay us, we're receiving cash, we're reducing our accounts receivable. As that happens, we adjust for that accounting period. Remember, in accrual-based accounting, we recognize the cash when it's earned. So these are adjustments that we would make. And then identifying the changes. Inventories. As we sell inventory at the end of the year, we need to make adjustments for inventory. You learned a lot about this stuff in the adjusting entries back in, I think it was like chapter 3. It's a long time ago. It was like 5-6 weeks ago. I know, right? Time flies. That's inventories. Accounts payable. As we pay our bills, of course, we're reducing our cash, and therefore we need to make adjustments to cash based off of the payment of our bills. Accrued expenses. That's accounts payable increase. You account for that. Income taxes payable. When we pay our income tax, we decrease cash, decrease income tax payable. And that represents the cash flows for this company. Almost done. Property, plant, and equipment. These are all adjustments made to the investing activities. These are examples of how those adjustments are made. Yeah. Bonds. So now we're getting into financing activities. Bonds payable. Common stock adjustments. Dividends. When we pay dividends out, declare the dividend, decrease cash. Dividends. Oh, dividends fun. I wish dividends were that high. All right, statement of cash flows. Let's put it all together. Statement of cash flows. Net income plus and minus operating activities equals net cash flow for operating activities. Then we have our investing activities. Plus and minus from investing activities equals net cash flow from investing activities. Then we have financing activities. Cash coming in, cash going out for financing activities gets us the net cash flow for financing activities. What you do is you take your net income plus or minus from operating, investing, and financing activities equals your net cash increase plus cash at the beginning of the period equals your cash at the end of the accounting period. That's the indirect method. In business, as managers, as investors, we need to understand free cash flow. Free cash flow. Here's what it means. Free cash flow is something that we look at in order for the business to understand the business's potential to grow, potential to reinvest in itself. Free cash flow is also call this working capital. working capital. We're going to talk more about working capital in the next chapter. But free cash flow helps us to identify working capital, to recognize the ability to purchase or sell additional property, plant, and equipment, and of course to maintain its current operations. We take, to calculate free cash flow, we look at cash flow from operating activities, cash used to purchase property, plant, and equipment to get free cash flow. How do we figure out the ratio for free cash flow? Free cash flow can be expressed as a percentage. We take free cash flow divided by sales. Again, how do we get free cash flow? Cash flow from operating activities. Cash flow from operating activities minus cash used to purchase property, plant, and equipment equals free cash flow. So we figure out free cash flow divided by sales. Sales, that's your revenue coming from the income statement. Make sense? You're all still awake? Hopefully I didn't bore you all. I know some of this is really boring. You're all still with me, yeah? You can hear me. I'm still talking.
Yes, we can.
Awesome. Thank you. I appreciate it. I know it's boring stuff. I know. The next chapter is more interesting. Thanks, Mike. I'm glad that you're still here. All right. Positive free cash flow. That's good. Positive free cash flow. Yes, it's a good thing. Company that has free cash flow is able to invest into the company, to grow, to expand, all of those good things. And of course, they might be able to pay dividends. Yay, dividends. Company with no free cash flow is typically in trouble. Yeah. Sears. Oh, Sears is a great example of a company that does not have free cash flow. If you don't have free cash flow, you don't have flexibility. It leads to liquidity problems. It makes it difficult for them to pay their bills. Yeah, gotta have free cash flow. The same is personal, right? For those of you looking at this from a personal perspective, having free cash flow is super important for your lifestyle, right? You got that extra cash to go out to the club, right? You got that extra cash to have a nice party. Yeah, free cash flow is super important. You got to make sure that you're even after your investments into your house, you're paying your mortgage, your rent, your utilities, all that good stuff, or you're paying your car loan, the property, plant, and equipment stuff. Operating cash minus property, plant, and equipment stuff equals your free cash flow, yeah? So, good stuff. All right, let's look at free cash flow from an example. We have our company, 3 years data, cash flow from operating activities minus cash used to purchase property, plant, and equipment equals cash flow, free cash flow. Free cash flow divided by sales gets us to our ratio. So operating activities minus cash used to purchase property, plant, and equipment equals free cash flow. Free cash flow divided by sales equals a ratio. You guys are good at this stuff. I know you are. Oh my goodness, we made it! Oh, that is wonderful news. We got to the end of the statement of cash flows. Wow, holy smokes, that is great. And we did it within 1 hour. Can you believe that? I can barely believe it myself. Okay. Questions, comments, concerns on the statement of cash flows? Anything?
Me. So, have you ever had like any experience, calculating cash flows from real estate properties?
Yeah, absolutely. Yeah, so for real estate that you are looking to invest in or to purchase in, you look from your operating activity, quote, air quotes, operating activity when we're talking about running a property management company. Your operating cash inflow is going to be the rent that you're receiving from your tenants. Okay. The outflow is going to be repairs that you're making on the buildings. That's operating activities, right? So inflow is your rent that you're collecting from your tenants. Outflow is going to be repairs that you're making on the buildings. You know, day-to-day maintenance, whatever, or other expenses for the buildings, like your property tax and whatever. Gets your net cash flow for operating activities.
Because
Go ahead.
you know the mentor I follow. I don't know if you've ever heard of Grant Cardone. You know, he recommends, you know, to buy properties that make at least 20% annually cash flow, so you can double the money in 5 years. So that is where it's recommended.
That's a good rule of thumb, yeah. Yeah, and that makes sense. That's probably the rule of thumb that I would make, and that gets you so that 20% that the mentor is talking about that is the free cash flow. So operating activities, rent coming in from your tenants, minus your maintenance, property tax, whatever other expenses day to day, equals the net cash flow from operating activities, minus the cash you're going to use when you purchase additional property, equals the free cash flow.
You almost will have no cash flow in DC. Like investing in DC right now, income plus federal. So
I know.
you better to invest in Florida or somewhere else.
I know exactly what you're talking about. In fact, I'm closing on a property tonight at 6. So
Oh, congratulations.
thank you. That's my first one, so I'm excited about it. So okay, great, good question, Richard. Any other comments, questions, concerns on statement of cash flows before we call this one done and move on to the next chapter? We will take a short break. I need like 5 minutes. Any comments, questions, or concerns before we take a break? We're good? Okay, wonderful. I'm going to stop the recording for this chapter. We'll start the next one in about 5 minutes, okay? So please take a break.